Recently, on the 13th of September, Brookfield uploaded their Investor Day presentations to their YouTube channel. Since Brookfield Corporation makes up a decent sum of my portfolio, I obviously went to have a look at what they had to say. In this video, I will cover what were, for me, the highlights of their presentation with some additional commentary for my part. I'll start by summarizing a few of their numbers here, because in their presentation they stated the following. They are currently generating $5 billion in cash flow a year and are expecting to generate $45 billion in cash over the next 5 years. This cash is used to optimize the business where possible. As they are huge advocates of reinvesting their capital, do not expect a big dividend increase or share buybacks, although they will do buybacks if it seems like the best bang for their buck. They also have $60 billion of listed securities that can be turned to cash if required, which does provide quite a big cushion in case they might need it. As to what this means on a per share basis, let's have a look exactly at what Nick Goodman has to say.
In the last 12 months, we've grown our DE before realizations. We think of this as our more stabilized cash earnings by 22% per share. That's 22% per share growth over the last 12 months. That's been driven by really strong performance and growth in our asset management business, our insurance solutions business, which 3 years ago generated zero. Last 12 months at June 30th, $634 million of earnings. And as Sachin will touch on, from just the secure growth is poised to double and can significantly grow from there. Our operating businesses have continued to generate really stable cash flow. In infrastructure and renewable, through our operating expertise and inflation escalation, FFO continues to grow. Our private equity business continues to grow EBITDA, and our real estate business, as you'll hear us talk about, and maybe despite the narrative, the highest quality assets continue to capture revenue growth and strong demand from tenants, and that's driven to strong earnings. There's 21% growth in total DE, but when you factor in the reduction of share count through repurchases, is 22% per share growth.
Now, it is important to know that this number is without realization, so buying or selling of additional assets, which is one of Brookfield's strong suits, are not factored in here. You also heard him say that, contrary to what the news says, their real estate portfolio is performing well. They have a segment on that later on as well, so I'll definitely get into that later down the line, don't you worry. Because right now, the real estate portfolio poses one of the biggest risks here. But before this, here is a small segment on what Brookfield believes their share price is worth based on a per share basis.
Now turning to the valuation. And if you look up on the screen on the left-hand side is the traditional way that we would present our valuation. It takes the component parts of the business, our asset management business being our ownership of BAM, our direct investments into the asset manager and our carried interest, our insurance solutions business, and our operating businesses, which are underpinned by some of the highest quality assets and cash flows globally. If you add that up and net off the debt, we get to a total planned value today of $120 billion, or $74 a share. But if we think about that as a multiple of DE, think about BN as a business that generates earnings and is going to deliver, in our plans, 25% compound annual growth in earnings over the next 5 years. Against today's DE of $5 billion, that's a 24 times multiple for planned value. But if we look at that on a forward basis and look at our 5-year average projected DE, not the DE at the end of the 5th year, the average over the 5 years, that's a 15 times multiple on today's planned value.
Based on the sum of their parts valuation, they noted their current net asset value to be worth $74 a share. Now, net asset value is not a metric that I tend to use, as I prefer to be more income oriented and prefer to look at their cash flow growth. But net asset value basically sums up all the assets that they possess and divides it by the total amount of shares, similar to what I have done in my fair valuation for Brookfield video. Given that the price is currently around $30 and the NAV is $74, this is a massive discrepancy and may be worth a look. Given this discrepancy, management have authorized share buybacks to be utilized to increase shareholder value. And given how Brookfield likes to reinvest their capital, they must truly believe their current share price to be quite low. But before we pull the trigger to buy, let's move on. In the following slides, they talk about their liquidity and carried interest numbers to fund their operation. Interesting, but not interesting enough for me to highlight here. Next, they project the growth of their asset management business, BAM, to grow distributable earnings by 18% CAGR a year, based on the increase in fee-bearing capital on their managed assets. Seeing how Brookfield continues to raise record amounts of money, I can see this come true. Next, they'll talk about their insurance business, a relatively new segment of their portfolio and one that they are heavily investing into. They will focus a lot of their attention on this, aiming to get a 40% increase in distributable earnings and assets. Their total earnings, which are around $700 million now, are expected to increase to $3.9 billion in 2028. Now again, just for good measure, they currently have a distributable earnings of around $4.6 billion in total. So for them to realize $3.9 billion on insurance alone in the next 5 years is a very ambitious goal. Normally, I would say that it's too ambitious, but given Brookfield's track record and seeing the growth that they already have realized here for the past few years, maybe I give them a bit of leeway here. Anyway, it seems that Brookfield, who is an alternative asset giant, will be heavily into insurance in a not too distant future. Very similar to their rival and more famous counterpart, Berkshire Hathaway. Now on to real estate. This is a very important part of the presentation because many believe that the reason that Brookfield's share price is down so low is due to the increased interest rates, which especially affect high debt companies like Brookfield. Brookfield has a lot of debt because they buy up infrastructure, which is simply a very capital intensive. But much of the debt that Brookfield Corporation has is in their real estate business. It's in their real estate business which seems to be struggling. Let's see what they have to say.
So, in conclusion, and to bring all of that together, despite what you may be reading in the papers today, the fundamentals and tenant demand for high quality real estate with a proven manager like ourselves continue to be in high demand. We have high occupancy within these assets and tenants waiting to come in. No question, short-term interest rates and changes in short-term interest rates over the last 12 months have had an impact on short-term cash flows, but the long-term value of these assets is unaffected. We have a well-laddered debt maturity profile and a bulletproof balance sheet that means we can continue to withstand any kind of market volatility that we may see. And with rate increases now largely behind us, we see the opportunity to continue to generate compelling returns on our real estate for Brookfield.
In their entire presentation, they mostly talked about their amazing occupancy rates and good relationship with their tenants. And whenever they do this, I get a little bit suspicious. Why not give us the cold hard numbers? So I had a look at their 2022 annual report of property section where I saw the following income statement. They had a massive decrease in earnings for 2022 compared to 2021. But once I started looking closer, their income statements are all over the place and mostly influenced by their fair value gains and losses. Basically, their properties are valued differently, which is included in the income statement. That's not too telling for me. So while it looks bleak at first sight, this seems to be mostly an accounting thing. Let's have a look at their cash flows instead, where we can see the cold hard cash numbers without accountants playing games on us. The cash flow shows the following, with these being the operating cash flows. All the accounting things like fair value is added back, yet their numbers are still down a lot from previous years due to working capital expenses, which is money that they need to pay short-term expenses that are due in the next 12 months. What portion of this is delayed receivables or increased interest costs is not clear based on this number, but neither are positive for the business. So yes, while I do agree that their portfolio is still performing strong, posting record revenue numbers year after year, it also shows me that right now, their working capital costs are eating their cash flows. Now, obviously, during an investor day, they want everything to be rose-colored and don't want to show numbers like this, but I do think it's important to know them. Once the interest rates go down again and their cost decreases, their real estate portfolio will undoubtedly create very good cash flows. But right now, as interest rates are high, and with maturing debt requiring refinancing at these higher interest rate numbers, it's definitely the black sheep in their portfolio. On the other hand, it does seem that they are paying down their debt to mitigate this risk as much as possible. Brookfield can't control the interest rates and is just playing the hand that dealt, and I think they're doing a very good job at that. So overall, Brookfield is ambitious with their forward endeavors. They expect their insurance branch to provide immense returns and capital for their operations and have increased cash flows consistently. And while their property section is in troubled waters right now, Brookfield has plenty of capital to weather that storm. They have been investing heavily into acquisitions and expansions, and once the interest rates stop eating into their profits, I imagine Brookfield to rebound immensely. They are doing share buybacks due to their perceived undervalued shares, and you can pick them up right now for $30, while Brookfield believes them to be worth $74. Call me biased, which I am, but I think Brookfield is still an attractive option for any investor. So this was a short video on Brookfield's investor presentation. Thank you very much for watching. Don't forget to like, subscribe and all that good stuff, and I'll see you in the next one. Cheerio!